Stop what you're doing. Seriously, if you're a retail investor looking at the frontier tech space right now, you absolutely need to hear this explainer. Because last week, I sat down and ran Quantinuum's IPO prospectus through 5 rigorous fundamental valuation models, and then I cross-referenced the whole thing with Peter Lynch's classic growth traps. And honestly, what I found completely shocked me. Today, we're breaking down what is undeniably the most anticipated and probably the most polarizing market debut we've seen in recent history. By the end of this explainer, you are going to know exactly if this quantum giant is the ultimate Buffett buy and hold or just a massive Lynch value trap.
Okay, let's start with a number that is just going to blow your mind. $15.56 billion. That is the staggering, fully diluted market capitalization Quantinuum commanded the second it hit the Nasdaq, pricing at $60 a share. To put that into perspective, they're being valued right now like a mature cash-printing tech giant. But the reality? This company is still firmly in its pre-scale research and development phase. The market is literally pricing an absolute flawless execution a full decade into the future. It's like valuing a prototype concept car today based on the assumption that it's going to completely dominate the global auto market by the year 2035. Which brings us to the massive elephant in the room. And here's a bold rhetorical question every single investor has to be asking right now. How on earth does a company with a jaw-dropping $136.6 million GAAP net loss, and that's just in the first quarter of 2026, by the way, command such an incredible premium? Look, I get it. It taps into that common fear we all have as retail investors. Are you genuinely getting in on the ground floor of a technological revolution, or are you just stepping up to provide exit liquidity for Wall Street insiders? Warren Buffett always says you should only invest in things you truly understand and can reasonably value. But how do you value quantum supremacy? It practically breaks every traditional metric we have. But don't worry, we are going to strip away the hype, go line by line through the actual financial reality, and I promise you a clear, actionable framework that you can steal to evaluate this stock for yourself. So here's our roadmap to untangle all this madness. Number 1, we'll look at the actual mechanics of this $15 billion quantum leap. Number 2, we're going to decode the trapped ion technology at the heart of it all. 3, we'll examine Uncle Sam's strategic quantum bet. 4, we'll do a harsh but necessary financial reality check. And finally, number 5, we're diving deep into these structural risks and hidden bottlenecks. All right, let's jump right into section 1, a $15 billion quantum leap, where we'll look at the exact mechanics behind this historic market debut. What's really fascinating here is the sheer institutional frenzy that led up to this listing. The offering was so massively oversubscribed that Quantinuum was actually able to upsize the IPO, eventually selling 28 million shares at $60 a pop. That generated a whopping $1.68 billion in gross proceeds. Trading under the ticker QNT, they're now sitting on this estimated post-IPO liquidity fortress of $1.6 billion. But hey, don't let the public float fool you. Check out that last point on the list. Because of a dual-class share structure, parent company Honeywell still retains about 48.1% of the combined voting power. So make no mistake, they are very much still the ones pulling the strategic strings behind the scenes. So how exactly did they convince the market to hand over that kind of cash? Let's move to section 2, decoding trapped ion technology, because this is the actual tangible science driving all this hype. The core tech differentiator here is actually super cool. See, the quantum industry right now is kind of divided into different architectural camps. On one side, you've got giants like IBM and Google banking on superconducting circuits. The catch there? They require these massive dilution refrigerators to cool chips down to near absolute zero using liquid helium. It's intense. But Quantinuum, they go a completely different route with what's called QCCD, or quantum charge-coupled device architecture. Basically, they use electromagnetic fields to suspend these perfectly identical ytterbium ions in a high vacuum, and then they manipulate them with high-precision lasers. Because they can physically shuttle these ions around the trap, they achieve what's known as all-to-all connectivity. Think of it like a massive highway system where every single car has a direct dedicated lane to every other car, completely eliminating those massive traffic jams you'd normally see in fixed-grid superconducting chips. But the real kicker is how this crazy underlying physics is supposed to translate into a commercial product over the next few years. Just look at this timeline. In 2025, they deployed Helios, using 98 physical qubits to create 48 highly stable logical qubits. That was a massive breakthrough in reducing error correction overhead. Then, looking ahead to 2027, their Sol system is targeted to hit roughly 100 logical qubits with a 5 nines, or 99.999% fidelity rate. But guys, 2029 is the true holy grail here. That's when they plan to launch Apollo, which they envision as a commercial-scale, fully fault-tolerant system.
So when you buy the stock today, the public markets are effectively funding this exact 4-year bridge.
But guess what? The private sector isn't the only one funding this bridge. Let's move to Section 3, Uncle Sam's Quantum Bet, and let's talk about the intense geopolitics at play.
Just a few weeks before the IPO dropped, this single number completely changed the narrative. $100 million. That's the funding amount proposed in a non-binding letter of intent from the U.S. Department of Commerce, right under the CHIPS and Science Act.
Now, the absolutely crucial takeaway here is that this is not just some typical government grant. The U.S. government is actually taking a direct minority equity stake in Quantinuum at a discount to the IPO price. This fundamentally transforms the government from just being a primary customer into an actual equity shareholder. For a capital-intensive company like this, it effectively designates their hardware as critical national infrastructure. That creates a massive valuation floor and basically insulates them against broader tech market corrections. But yeah, there's a catch. This backing mandates strict U.S. exclusivity for any funded innovations for a full 10 years, basically locking that intellectual property firmly under U.S. corporate ownership. Huge geopolitical implications there.
All right, so we've seen the technological promise and the heavy sovereign backing. Now, it's time to look at the peril. Let's move into Section 4, the financial reality check.
This is where the sobering reality of investing in frontier tech hits you right in the face. Just look at the income statement. Total revenue for fiscal year 2025 sits at $30.9 million. Sounds okay, right? But if you actually dig into the filings, over half of that, around $16.5 million, was recognized entirely upfront from a single on-premises hardware lease. If you strip that one deal away, their recurring cloud revenue actually shrank year over year. And then, brace yourselves for the GAAP net loss. They lost $192.6 million in 2025, and then another $136.6 million in just the first quarter of 2026 alone. Their annualized cash burn is just astronomically high, with net R&D expenses equaling more than 500% of their total revenue in 2025. Honestly, their only saving grace right now is that massive cash buffer, which is explicitly designed to keep the lights on until that Apollo system launches in 2029.
And when you take that tiny revenue base and stack it up against a $15 billion valuation, you get this. Quantinuum is currently trading at a mind-boggling 505 times price-to-sales multiple based on 2025 numbers. 505 times. Compare that directly to IonQ, their closest pure-play competitor in the space. IonQ generated $130 million in FY 2025 revenue, way more than Quantinuum, yet they're trading at a much lower 179 times multiple. Basically, the market is completely ignoring current revenue generation and instead paying a massive premium for Quantinuum's high gate fidelity metrics and their long-term IP roadmap. It is a very, very long bet.
Aside from those extreme valuation multiples, there are some pretty major traps buried deep in the prospectus. Let's head into our final section, structural risks and bottlenecks, because this is the exact fine print every retail investor needs to know about. First up, we have to talk about a massive, glowing vulnerability, customer concentration. In fiscal year 2025, a staggering 60% of Quantinuum's total revenue came from one single source, Japan's Institute of Physical and Chemical Research, also known as RIKEN. Seriously, one customer. In fact, going into Q1 2026, government and government-affiliated research institutions made up the vast majority of all their sales. This means their short-term performance is incredibly fragile. Literally, any changes to sovereign research budgets or sudden geopolitical shifts could totally wreck their top line overnight.
And finally, we arrive at the sleeper risk. Quantinuum actually went public using an Up-C corporate holding structure. Now, they did this to preserve tax benefits for pre-IPO unit holders, mainly Honeywell. Under what's called a Tax Receivable Agreement, or TRA, the new public company is legally obligated to pay those pre-IPO owners 85% of the cash tax savings it eventually realizes. The filings projected this little setup is going to drain an astonishing $3.53 billion of public cash flows over the next 25 years. And it gets worse. If the company is ever bought out or changes control, all those future payments automatically accelerate into an immediate lump sum cash liability. That severely limits their strategic flexibility going forward.
So after running all those models and looking past the hype, the absolutely crucial question we're left with is this. Is Quantinuum a visionary asset that's going to define our technological future,
Or is it just a $15 billion bubble floating on a 55 times revenue multiple? Look, they possess a cash fortress, industry-leading trapped ion science, and the direct sovereign backing of the U.S. government. But on the flip side, they are heavily burdened by astronomical burn rates, dangerous customer concentration, and billions in structural liabilities hidden right there in the fine print. The road to 2029 is not going to be boring, that is for sure. Thank you so much for joining me on this explainer. Keep learning, keep digging into the data, and I'll catch you next time.